So now let's move into the quarterly trailing 12-month revenue growth. So this basically adds up the last 4 quarters of revenue. And yeah, maybe you could break this down for us. I see Tesla scaling to about 24 billion. It seems like we've hit like a sort of pause as they reach capacity of the Model 3 production line. And that's what's interesting about Tesla is so much of their growth and their trajectory is guided by their ability to increase production. And so now that we have them bringing on Model Y, bringing on Gigafactory Shanghai, additional production, this number should start to go up. But what does this chart tell you? Why is this important?
Yeah, so just really high level, the way I interpret the revenue growth or just revenues in general for any company is it's essentially a reflection of the sheer raw demand for the products, right? So, Tesla could have industry-leading margins or whatnot. It could have the best profitability or whatnot, but revenue is basically a reflection of the demand for the product. And, the big question a couple of years back was, what's the demand for these vehicles like? Are consumers going to be willing to take on, the slight, inconveniences of an electric vehicle, right? You have to charge, find a place to charge. You have range anxiety. You have other issues. You have, not as robust of a service network and things like that. So the big question is, are consumers ready to adopt electric vehicles? And so I look at the revenue growth, and that's telling us exactly that, it is catching on. It is gaining share, as we saw in the previous chart. So revenue growth itself is just a raw, measure of demand. Now, the next chart, however, which is the Tesla gross profit, right? That tells us, what is the raw, measure of profitability. And it's this number where I think it's going to get really interesting over the next year or so. Because of another chart that Tesla showed on one of their previous shareholder letters. I think it was from Q3 of 2019. But basically, it was a small little bar chart. It was a tiny little chart that they had in that, where they showed the total Capex that's required for the Model 3 built in Fremont. Next to that is the total Capex of the Model 3 built in China. And then next to that is the total Capex of the Model Y. And the Model Y is significantly lower than either of the previous two. So the most expensive car was made in Fremont, Model 3. Significantly cheaper than that is made in China, Model 3. And even more significantly cheaper than that is the Model Y. So I think, with the effect of the Model Y, you're going to see not just a bump in revenue, because the Model Y is attacking a much bigger segment, but you're going to see a greater bump in gross profit. So revenues may grow, say 40, 50%. I'm not sure exactly what it's going to come out to in 2020. But gross profit is actually going to grow, in my opinion, even faster than revenue growth, because the incremental Capex spend, therefore less depreciation, is a lot less compared to Model 3.
Yeah, and this is a really interesting part that I think maybe you glossed over because it's kind of complex, where Tesla has to pay for these production lines up front to build a car. And Tesla's a new company. When they built their first mass production line for a Model 3, it was kind of a disaster and a mess up. That's why it took so long. They had to build the GA4 in the tent. There was all these sort of hiccups, but they learned from that, and all these efficiencies we're seeing financially play out in reduced Capex per unit of output, which is that metric you're saying. And so can you really dive deep into how that metric impacts gross profit? Because my understanding is it's less of a cash thing where it's like they paid less to build out all of these production lines. So that depreciation of those production lines is less when they go back and actually start pumping out cars. So that's why in theory, we haven't really seen the impact of these Capex improvements on the income statement until we see production ramp from Gigafactory China and from Model Y, because that's when that incremental depreciation will be that, cut in half per unit. So is that what you're talking about, of where we're going to get to see that Capex improvement start to show up on the income statement this year?
Exactly. Yeah. And there's a direct link between depreciation and Capex, right? Because Capex is the amount of money that's spent to acquire all the tooling and the factory itself. right? And building out that factory. So as that is spent up front, it's then depreciated over time, which hits the income statement over time gradually. Whereas, if you're looking at the cash flow statement, it actually hits right up front. So it's not a recurring charge. It's a one-time hit all up front. However, with the Model Y, I think, and given all the tidbits that Elon has given, even on the most recent Third Row, Tesla podcast, I think he pretty much reiterated that same point, which is that, Model Y, it's not going to be very different from a user standpoint compared to Model 3. But the internal sort of, complexity of the body itself is so much simpler than Model 3 that the amount of Capex that's needed to build it out is going to be significantly less than Model 3. And I think we've already seen that because, throughout 2019, there wasn't a whole lot of Capex that Tesla, put out there. They were way below their forecast. I think they spent about 1.5 billion or slightly less than that in 2019 on Capex, which is very low. It's almost too low, too low to believe, but that's going to pick up this year. So I think their guidance this year is about 3 billion in Capex, which is, a doubling from last year. And that's probably expected because the ratio of Capex to depreciation had fallen basically below 1. And usually companies can't ever sustain that. That's never long-term sustainable because you can't spend less than what it takes to maintain your existing factory and tools and things like that. So it can dip below 1 for a while. There's many companies that have this. Amazon is below 1. Home Depot, I was looking, is also below 1. So many companies can have Capex that's less than depreciation for a while.
And that's because it's really cyclical, right? It's what we're talking about is like, that's why Tesla looks so like a juicy business the past year or so, because they put in all this Capex in 2017 and 2018 to build up those lines. And then now they didn't really put in Capex. They're just taking out all these cars and all these non-cash expenses. But then it's very cyclical. And that's why I always say, like, man, this COVID hit at the perfect time for Tesla, because they were at this part in the cycle where they had the most cash ever, and they're about to pump in all this excess cash in production, and they can kind of wait and slow that down, as they see demand playing out. But anyway, so I didn't want to interrupt, but.
Yeah, no, that's exactly it. Yeah, so we're going to see that wax and wane over time. It's going to be cyclical. I know it's been one of the big, talking points of the short sellers that, they're super underspending on Capex. And I think that's a fair point, and that's going to come back up.
But it's also like, so you're getting mad at Tesla because they're getting like their, bear case is actually our bull case. I'm like, yeah, you're baffled about how little they're spending on Capex, and it doesn't make sense to you because you refuse to acknowledge that Tesla's rate of improvement at actually building out these production lines is getting way better faster. And that's the big difference. And they just refuse to acknowledge that.
Yeah. No, exactly. And as another chart is going to show, coming up here, the one of the biggest bear talking points is that, Tesla is a capital intensive business, just like every automaker out there. And yet they have, they're trading at a massive premium, to everybody else. And we're going to see, I think, why that is. And it's specifically due to this one point that we're discussing right now, which is the ratio of revenue to Capex, and also the ratio of EBITDA to Capex. I think these two things are going to be critical to understand why Tesla is not anywhere close to being as capital intensive as the overall auto industry. And Model Y, I think, is going to be where that finally reveals itself. So starting this year.